Impressive revenue growth of HCL rendered ineffective by continuous margin pressure. HCL Technologies, among the top IT companies into computer programming and consultancy related services, enjoys a market cap of over 2,50,000 crores and ranks third in terms of revenue and market cap, has sizable profits, and the resulting PE multiple is quite superior, being below the sectoral PE of 25.2. Predominantly an export-oriented company. Major contributors: America and Europe, forming about 85% in aggregate. Indian share on the decline to 2.5% in the recently concluded year. Revenue from rest of world showing good improvement. Domination by America and Europe. Committed shareholding by promoters almost unchanged over 4 quarters at 60% plus. Mutual funds add to the extent of almost 3%. It is FPIs who have reduced their stake by over 5% and DIIs have increased by about 1.2%. Minor changes in the holding of retail and others. Promoter commitment quite evident in the strong and consistent holding. Company worst affected by inflation in employee costs and outsourcing costs. Over 3 quarters, June 20, June 21, June 22, trading stock remains almost the same, but substantial inflation observed in outsourcing expenses from 13.6 to 15.3. Major damage coming from employee costs, moving from 51%, almost 4.5% up. Other expenses remain the same. The impact of input inflation on EBITDA is sizable, falling from 26.7%, EBITDA reaches 21.2 by June 22. Employee cost and outsourcing costs play havoc with financials of HCL. HCL suffers divergence between EBITDA and revenue growth. Over last 9 quarters, revenue has remained sizable, moving from around 17,000 crores to 20,000 crores in June 21 and to 23,400 crores in June 22. The growth has been quite decent in the initial quarters, but improving from June 21 quarter 12.5% upwards, reaching up to 16.9% in the recent quarter. But the dampener is EBITDA percentage, which has been consistently falling from 26.7 to 25.2, then to a low of 21.2. What is concerning is 6 quarters of continuous fall in EBITDA percentage, unidirectional, descending. EBITDA is badly affected. Company's growing capital employed is not getting proportionate return. During last 5 years, due to retention policy, company's capital employed moving up, but there is absence of corresponding increase in earnings before interest and tax, rightfully reflected in a fall in return on capital employed percentage, moving to a low of 24.8%, falling regularly year after year. Return on capital employed has become a casualty. Lower return on capital employed prompts the company to go for bumper dividend during FY22. Company's overall profit has been on an increase. Dividend was normal and consistent. Payout has seen an upward surge in FY22 along with a corresponding yield improvement. The median payout has remained 23.6%, but the recent payout is 84%, almost 4 times. Similarly, yield, which has a median value of 1.6, has moved to 4.5 due to the abnormal dividend. Higher dividend only to report improvement in return on capital employed going forward. Consistent strong generations from operations, operational cash flow growing year after year, peaking at 17,450 crores in the recent year. Normal working capital movements. Dividend has peaked to almost 11,400 crores during the current year. As a result, the operating surplus residual has fallen to 5,500 crores. With its normal fixed assets, financing propositions and 2 buybacks in 18 and 19, the company has history of strong cash balance, with the recent year having a cash balance of over 10,000 crores. Strong cash flow. Ukraine conflict and fears on global recession are worrying HCL as it receives almost 85% of its revenue from US and Europe, whose slowdown might impact the company to a large extent. I am Vittal Prabhu with the weekly video on Stock Learning Simplified. Hope you will find the video informative and interesting. IT and business services leads in revenue share and products and platforms lead in PBT percentage. IT and BS forms almost 3/4 of the revenue of the company. Engineering and R&D bringing about 16% and lower share of around 10% coming from products and platforms. While the proportion is maintained in terms of PBT share, IT and BS being the major contributor, but the PBT percentage proper of engineering R&D is better than IT and BS, and product and platform has the highest PBT percentage, and hence the company focuses on growing products and platforms going forward. From the IT space, HCL appears sound investment proposition. As compared to Infosys and TCS, it has always carried a discount, and the discount in March 21 appeared around 45%. It has come down subsequently, but the current rate of discount to the sector maximum is around 38%. That makes HCL a strong investment proposition from valuation and margin of safety perspective. HCL follows a triangular pattern in its daily movement. Current market price is below 200 EMA and also below 50 EMA. Reached a 52-week high in September 21 and had its low in July 22. The current market price carries a discount to 52-week high to the extent of about 30%. The current market price is midway through the minimum Fibonacci retracement level of 23.6% and is worth waiting for an entry level. Price and quantity movements in price action are quite suggestive. Price has had a fall but very marginal, 946 to 936, 1%. During the period, quantity has moved from 33.7 lakhs to 21.08 lakhs per day, suggesting a massive fall in quantity, almost 1/3, a small fall in price, a deeper fall in quantity, suggesting bullishness impending. The price and quantity movement is reinforced by delivery percentage and average quantity per trade. Delivery percentage has moved up from 59% to 62%, suggesting genuine transactions involving delivery. And at the same time, presence of stakeholders with bulk interest is evident, as average quantity per trade has consistently moved up on all time frames, and this reinforces the impending trend of upward movement in the near future. Price action movement is once again supported by the option chain with an ATM level of 920 and a strong build-up at the total level above ATM between 950 and 960, and that is quite promising. Option chain is quite positively inclined based on the product of summarized option chain. For an ATM of 920, pain gain point appears at a higher level of 940. The positivity is also evident in the upward movement in the premium beyond the ATM level, appearing at multiple levels, and this bullishness in premium beyond the ATM is suggestive of a strong positivity in the near future. HCL is a company of great reputation and has grown and proven based on its strong capabilities and a consistently growing order book. Given the current global situation, company's guidance for FY23 with a revenue growth between 12 and 14% and an EBITDA of a minimum of 18% is quite reassuring and keeping with the performance of the company. Hope this video on HCL, the IT giant of the country, came up to your expectations. You can access similar videos with rich content at our info card on Stock Learning Simplified. We look forward to your likes, shares and comments. If you are new to the channel, may please subscribe and press the bell icon for timely intimation on our forthcoming videos. For your valuable time and kind support and interest, highly obliged. This video is for purposes of information, education and awareness only. This is not meant to be a solicitation or recommendation to buy, sell or hold securities. Wherever applicable, please seek the advice of a competent professional before taking action of any kind.